Is that working? I think it's very quiet, is it? Okay, yeah, great.
Andy Taylor's saying hello.
Oh, nice to meet you. Thank you, thank you very much. Thank you.
How's it keeping?
Yeah, busy.
I can imagine. Yeah,
Bit
likewise.
crazy today. I was carrying banners around the West End today. I didn't realise how hot it was.
Oh, nice.
A bit sweaty at my old age.
Yeah, let me know if you want to catch up.
Yeah, I'd love to. Thank you.
Because we're scaling up anything net zero that comes your way.
Yeah. Okay. That would be cool.
Yeah.
Did you ever talk to Tim? Sorry? Wouldn't match one of our directors.
Yeah.
Very sort of involved with sort of sustainability and
Tim in the white shirt on the outside.
white shirt. He's an architect by trade, but he's very involved with a lot of environmental things. Okay. Thank you, everybody. I'm Simon Glass. I'm the CEO of Qodeo. I think we might. Maybe we'll try and close the door. Maybe we'll slide the door closed. But thank you all for joining today, or maybe partially closed. I think there's probably some people arriving during the event, so 50-50. There we are. That's perfect. Just about. Well, maybe if we sort of leave it half closed, we can come in if they want to come in. In case they want to run out screaming, they can also run out. You see, if I go on too long. So I'm Simon Glass. I'm the CEO of Qodeo, and I'd like to thank you all for coming along today. We've got a mixture today of a great panel of some esteemed VCs. We've got, and we'll run through who those folks are. We've got folks from Wall Street Journal. We've got board directors here today from Qodeo. We've got angel investors. We've got entrepreneurs. Connections, obviously, the Judge Business School who are working with on this. And obviously, some connections have come through CMS, who are our UK lawyers who have helped support the event. And I'll run through that shortly. So a lot of you don't know much about us, so what I'm going to do today is tell you a bit about Qodeo, what we do, and then we'll go on to talk about some research we did with the Judge Business School. It was right before, which is the Cambridge University Judge Business School, the business school up there, did right before as the pandemic hit. Some of the trends you'll see are enduring, and some of the trends you'll see have changed, and then we'll discuss that with the panel afterwards. We'll then, I've got a few words from John Finmore of CMS. Now, CMS, our lawyers, run the Equip program, which is an entrepreneur-focused program. So basically give half-price legal fees to entrepreneurial businesses, but they give a lot of advice and events and support otherwise. They've been fantastic to us as our lawyers. They've actually underwritten and supported today's event. They've paid for today's event, which we're very grateful for. Unfortunately, John Finmore, who's meant to come today and join us, his kids and his wife went down with COVID this morning. So he called me up and said, should he come? And we thought probably best not. So we thought we might bring him in by Zoom, but that's always a bit clunky. So I've got some thoughts from him I'll bring on later, but I wanted to thank CMS for today's event. And thank you all also for coming on a warm summer's evening. So in theory, this clicker should work, but no action on the clicker. There we go. Okay, and that's the running order. Oops, go back here. Right, now it's running. Thank you. So, and we'll have some people come and probably join us during the presentation, so to obviously let them in. So I've run through kind of what I'm going to talk about. John Finmore obviously not here today, but we'll talk about his thoughts. He has got some thoughts. We'll have a panel discussion. So we prepared some ideas beforehand about interesting trends and issues that have happened subsequent to that report that was put together. And then we'd like to invite you to ask questions of the panel. More of the panel than of me. But happy to obviously answer questions about our business as well, but obviously we've got these great panelists here today to ask questions of. This is being live streamed, web streamed, both YouTube, I think, and Zoom. This will be recorded, and we'll have some sort of footage out after this. Anybody who's registered for the event today, and we have a lot of people sign up online, joining us today online. They will be sort of also receiving, as will you, a copy of the report that we're talking about today, and a copy of the presentation, and also a special discount coupon, which everybody here today can use if they want to sign up to Qodeo as an entrepreneur. So we'll open up to questions, Q&A from the audience, and Q&A from people online, and then we'll do the prize draw. I don't know if anybody has noticed that at the entrance there, Monica from Qodeo has got a bowl there, and if you want to put your business card in there, there's the opportunity to win a prize at the end of this evening, so we'll get that drawn later. And then we'll have networking. There's some food and drink to network afterwards. So I want to again thank CMS, the lawyers, for having effectively hosted this today, even in John's absence, and also the University of Cambridge Judge Business School, which is my alma mater, but also is a regular research partner of Qodeo's, and you'll hear some of the thoughts from the researcher there. And then just to introduce the panel very briefly, we'll come back to them. We've got four VCs, or three VCs and one sort of quasi-VC with us here today. We've got Sanjit Dote, who I met some years ago now at Outward VC, very interesting sort of VC, sort of more sort of B2B fintech focused VC over here in the UK. Will Ord from Conviction VC, also more B2B focused. Jonathan Lerner from Smedvig, partner, so a major UK firm, I think funded by Norwegian money originally, is that right? So that's hence the Smedvig name. And then we've got Matteo, who's Italian, who's here from L Marks, which is a sort of a corporate accelerator kind of company. So they work with lots of corporates to help accelerate businesses. I think with IAG, John Lewis historically, various other companies, Lloyd's Lab, helping accelerate various businesses and sometimes take equity stakes in early stage businesses, but more of a corporate related entity. So a bit of a sort of balance there in terms of who we'll talk to some of these thoughts about. So the first thing, if the I don't know if the man is still behind it, hello. So is what we're going to, if Morrissey is behind it, is what we're going to do is just show you a very quick video which will summarise what Qodeo does. In fact, there's one error in here that says that we have. It comes up on the screen saying 6,200 VC and PE firms we track on our platform, but actually the voiceover says 1,800 because it keeps on growing all the time. So the voiceover has not been revoiced, so it's out of date. But also we actually, our web application is called, so you can actually use our system online on a computer or on a mobile phone. But as of the next few weeks, we're going to be releasing a dedicated app which has very sort of advanced features compared to what we've currently got as a product. And so we are sort of truly an app as of the next couple of weeks' time. But if we can play the video, it gives you a very quick summary of what we do.
Did you realise the average entrepreneur and investor relationship lasts longer than most marriages? So you want to make sure you find the right match. Just like in love, there's a perfect match for entrepreneurs and investors. Qodeo automatically matches entrepreneurs with best fit investors, saving you time and money kissing frogs. Revolutionising the way entrepreneurs and investors match and get funding, businesses of all sizes can set up a profile in just 5 minutes and gain access to a world of opportunities for just $9.95 a month. And for a little more, Qodeo's concierge service can help you improve your profile so you attract the right investor even faster. Whether a startup or an established business looking to evolve, Qodeo connects you with opportunities far beyond your own traditional network. Always on the hunt, Qodeo instantly notifies you when your preferred match is found. No long courting process or middleman required. Qodeo helps you confidently connect directly with best fit investors worldwide, giving you access to more than 1,800 leading venture and private equity firms, pre-vetted by 30 of the world's top business schools. Qodeo matches you with the right funding, fast.
So that's a sort of brief overview about what we do, and obviously happy to talk to folks about that a little bit later. But basically on a web application, what we saw is that lots of entrepreneurs were kind of a bit befuddled by having to sort of try and sift through masses of data to try and actually work out where they're going to raise funds from. And likewise, VC and PE firms will see often lack relationships in various places outside their own networks. And we're looking both for sort of filtered inbound deal flow, as it's called, but also looking for new opportunities. And it's particularly important with diverse entrepreneurs who haven't been part historically of the circles that tend to dominate VC and PE. So as an agnostic, low-cost, easy-to-use platform, we can help sort of solve some of that problem, hence this democratization theme that we run with. So this phrase, actually cut through the noise, was actually a phrase given to us by one of the top VCs in the US, who first said to us, well, every VC knows everybody and they can obviously be able to reach out to who they want and they get bombarded by deal flow. And then I said, well, actually, but you get bombarded by deal flow and don't you miss out on opportunities at the same time? He said, yes, we have so much noise, we have to try and filter the noise. He put his hands around his head and said, you're like a headphone effectively, you're helping cut through the noise, doing noise cancellation effectively for us as a VC. So from a VC perspective, from a venture capital perspective, an investor perspective, there are many problems with trying to find entrepreneurs who sit outside your own networks. Josh Lerner, who's a professor at Harvard Business School, who's one of our advisory board members, actually commented to me that 80% of VCs in America he taught, let alone went to Harvard Business School. It's probably more like 40%. So the rest went to Stanford probably. But the problem is, as you even see that, those people have, there's nothing wrong with obviously what they've done, but those people have traditionally had engineering, consulting, investment banking type backgrounds, and have by nature relatively narrow networks. When I worked in venture capital in Cambridge at Amadeus Capital Partners years ago, we tend to know people on the campus, we didn't know people beyond. And venture capitalists aren't not no disservice to folks here today, but aren't historically sort of networkers per se, though obviously it's got better in the industry. And even however good a network you are, it's very difficult to connect with remote or regional entrepreneurs elsewhere in the UK from different kind of backgrounds. I was just in North Carolina the other week, and there's a huge amount of activity amongst African American entrepreneurs in North Carolina, for instance, and they find it difficult to get through to VCs. So if there's a low cost, easy way to reach, at least identify who to go and speak to, that's the first part of a process. And the entrepreneurs themselves lack capital, but there's this kind of overlap of lacking of relationships between both parties, and that's what we're here to help solve. So what is our solution? So basically, as you've obviously seen in the video before, we have a relatively simple sort of platform to sign up to. We've just actually produced a brand new interface. So as of the last couple of weeks, we released this new look, and we talk about sort of kissing frogs. So the dating analogy is interesting because everybody here in the room has dated in some kind of way, I would have thought at some point. Some of us more recently than others. But in that process, everybody says, you need to know what you're looking for effectively, and eventually when you hopefully end up with somebody, you have kind of refined kind of what criteria almost, what kind of things are important to you to try and match up. And very similarly, raising money is a very similar kind of process for entrepreneurs. There's no point talking to the wrong people at the wrong time. And what our product helps do is effectively shortlist who you should go and speak to, and does that filtering for you to know where to start your fundraising journey. So we've just released this new version of the site, and it talks about kissing frogs, which is obviously a very British expression, but tends to work globally okay, in terms of trying to stop entrepreneurs from wasting their time, wasting VC's time at the wrong time or the wrong place at various times. And it tells you more about what we do. So that shortlisting of the matches is the core of what we do, and we've now been increasingly rolling out certain functionality which enables what we call messaging. So the first stage of the process, who do I even speak to, and that's what effectively we can help try and identify for both the VCs and the entrepreneurs. And the second stage is, can I then reach out to them? And we have various functionality. Many VCs prefer to reach out to entrepreneurs on our platform rather than allowing entrepreneurs to reach out to them, because they want to sift what inbound opportunities are coming their direction on the opposite side of the spectrum. And then you also have VCs who are willing to be reached out to directly through the platform. But on the app version, we've got some improved, we call messaging, which enables that next stage beyond the shortlisting to then occur. So I'm going to move on to this. So that's a background about who we are, and obviously what we'd love to do is we'll tell you a bit more about us a bit later if you want to know. Today there is a special discount coupon we'll bring back up at the last slide, WOW Qodeo, W-O-W Qodeo in capital letters. And if you use that when you go online to sign up as an entrepreneur in the system, you get 50% off an annual subscription concierge. And concierge is our service that gives you feedback on your matchability as an entrepreneur to help improve your matchability, to help improve your fundraising chances. That's usually maybe £20 or €20 or dollars per month, 99 per year. You get 50% off that if you use the WOW Qodeo voucher that we're promoting today. People who are at business schools, so I know some of the folks here from the Judge Business School connection, we give business school partners who work with, give their students and staff free access to our platform to onboard them. So we'll let those folks know directly what their code is to get in for free. And I say everybody who's here today will get copies of the code, but also the report and the presentation today. So Qodeo works with about 30 leading business schools around the world. Cambridge Judge Business School is one of them. And what we do with these business schools is we principally have, we have a number of things we do with them, but principally what we do is have MBA students from leading business schools, or MFin students, etc., go and interview venture and private equity firms in person in the field. That's been done in a hybridized way in the last year or two, and it's going back now to more in person. And we interview VC and PE firms to get a sense of what makes them tick. So we're less focused as a business on the old-fashioned data per se. We're more interested in qualitative factors that make the business actually work. Why would a VC choose to invest in a particular entrepreneurial business? And we grade and identify various factors That information goes in our database, gets blended with public data and other source of data, and it runs through our algorithms. So when an entrepreneur comes in the system, wants to be matched with VC, a lot of that VC data has been collected in various ways, including those in-person interviews. And from the VC's perspective, much of their data is already preloaded on our system. So what we do is when these students go out and interview the VCs, we gather data, goes in our system, which runs our system. The students usually will come back and then present a copy of a report they write. So they write a related report, which is called a Qodeo View report, which is a market snapshot of the market they interviewed VCs in. So they go to a particular market at a particular time. So we've done projects in India, Japan, parts of the US, with many schools like Georgetown, UCLA, Cambridge, IMD, INSEAD, all kind of schools around the world. And they write a report, and that sort of summarise what they saw in that marketplace at that particular time. And then they often present. I want to actually thank Abhishek Srinivasan from Cambridge for Judge Business School, who did this research project I'm going to present to today, but he's actually in India for family reasons, so couldn't present today, but we often invite the student to come and present what they saw. So what we're going to do, which is a bit unusual, because this report was done right as the pandemic hit, is effectively bookend what the venture trends were that we saw across the UK. So Abhishek interviewed 85 VC and P firms across the UK, which is a very large spread of firms, and then wrote a report, and they gave us the data that he originated, that summarised the sort of trends he saw across the UK. Now 2019 was kind of peak, well, maybe 2021 was a later peak, but 2019 was kind of a high moment before, of course, there was a bit of a collapse in VC in the beginning of the COVID era, which then roared back very shortly afterwards. But there was a sort of a high point. So there was a significant amount of venture capital and private equity investment in the UK at the middle of 2019 when he was doing his research. What was important to us was that he actually went out and interviewed and spoke to VC and P firms across the UK. Like most other major markets, the UK is dominated by one or two major cities. UK, obviously London, to a certain extent these days Bristol, Oxford, Cambridge are a bit of a nexus, Edinburgh to a certain extent. But we made sure that instead of just interviewing VC and P firms in London, he went out to go and interview VC and P firms across the country to get a sense of also where they were seeing different trends. Because from our perspective, probably 80% of the entrepreneurs we can help sit outside obvious locations like London, because they don't have any access to networks or capital easily, and the platform can flatten those kind of barriers for them. So we went across the UK and interviewed folks, but obviously London continued to dominate. But obviously this Cambridge, Bristol, Oxford nexus was quite significant. When I worked in Cambridge, Kura lecturer was on my MBA, who's sitting here in the front. When we did our MBA back in 20 years ago roughly, there were one or two VCs really operating in Cambridge. For instance, there was no real cluster, it was beginning to emerge. There was some VC investing in the UK, but it was still a relatively new animal. And what's interesting is those clusters have grown, and Bristol is probably the most recent of those clusters, around intellectual property, around early stage, particularly in those particular markets. So we've got some people here coming in, so do come in and join, sorry, come in and join. There's some seats towards the, well, there's a couple of seats at the front, maybe like at the front, but there's some seats back too. But that whole nexus was quite a new thing when you look at it over the perspective of the UK growth in VC, but London remains a hub of activity, and there are different kind of issues and problems that entrepreneurs face outside London. Literally networking events like this are harder for them to access. I had some emails from various people today who literally outside London couldn't join us or join online instead. You don't get that networking effect afterwards because you're not in the hub, and that's a problem. So he then went out and asked us a whole series of questions that relate to how our database works, which is driven through our algorithms to create those matches. And there were various factors he looked at in terms of what were the most important factors or criteria that VCs used. Team is often an early stage criterion more than product or market, but he found product and team were the two most important criteria in terms of how VCs made decisions in the UK. And that does change by sector and stage and location, but VCs will tend to say they back the people first and the product second, but as you go up a continuum towards later stage, the product or the market becomes more important, it's more mature, and the people are more replaceable potentially. I had a meeting yesterday, a potential person wanted to invest into us as an angel investor. He said, well, what happens if you kind of fell under a bus effectively? You know, you are the leader of the business, we need you in the business still, whereas in a later stage business, it's easier to replace people effectively. Maybe some of my board who are here think I'm easier to replace, I don't know. So you have to ask them later. What do we see in terms of deal size, etc.? Now, what was happening in 2019 was increasing valuations and and more VCs effectively bidding against each other and bidding prices up. And we'll see when we have a discussion. There's kind of interesting couple of counter trends that have occurred very recently compared to that. And a lot of firms that we interview prefer to lead rounds, but obviously not everybody can lead rounds. How do people find deal flow? And this is where we sort of sit at a certain extent. Historically, firms said they all use trusted networks as one method of getting hold of deal flow. And that goes back to this old model of VC, that if you know somebody, it's easy to get referred in, that referral process. And I think we'll see with a lot of VCs who use referral. That's obviously valid. Interesting enough, again, Harvard Business School, there was a great report put out that showed that by Gompers, who's one of the colleagues of Josh Lerner, who we worked with at Harvard, and they went out and showed that VC or venture capital firms who invest in business like theirs, so they actually looked at particularly at ethnic communities, so they were actually looking at Indian background VCs in America who backed Indian background entrepreneurs, tend to get lower returns, and they did this with other groups as well, lower returns than people who looked across more diverse portfolios. And the reasons they found for that were particularly that you got groupthink, you got sort of the old-fashioned, what we used to call Me Too or I Too kind of thinking, too much similar thinking amongst people, and not enough questioning, and not enough breadth of the teams. And so if you naturally just go within your own network only, you miss out on so much opportunity. When we talk to female entrepreneurs, African-American entrepreneurs in Malta, where we were the other week, they don't even have a first ability to know where to start, and that's where we come in to help them begin to get in towards what we'd call an indirect trusted network, which we are. But cracking that trusted network is a major problem. One of the top VCs in New York who we work with said he gets in a car, or definitely before the pandemic, would get in a car and drive outside New York to try and find entrepreneurs across upstate New York and other places, because valuations of businesses were lower, the expectations of the entrepreneurs in many cases were lower, and there was more value add they could offer. But he was one of the few who bothered to get in a car and drive out and go and see people. And it's amazing how still this industry remains as a bit of a cottage industry despite its relative explosion in growth over the last few years. A lot of the businesses, it's very interesting, this thing about, on the bottom left-hand corner there, over 50% of the firms interviewed thought in 2019, at a peak, that there was a gap in the UK funding market between angel funding, so pre-seed or seed funding, and Series A. So for those who aren't familiar, so the more smaller stage investing before the VCs get in, there was a bit of a gap. And in fact, one of the folks who wanted to be here with us today, I'm not sure he's Jesse. Is Jesse here? I think he said he ran into a problem today getting here today. But one of the people who's a VC, kind of quasi-VC, was going to come today. They literally help bridge that gap. That's one of the things they do with convertible notes and other things to try and help fund entrepreneurs in between these different stages. But in other markets, you don't have that particular problem, and that was more acute outside London. There were a number of things that were going on. The US invasion is kind of interesting. We'll talk about a bit in the discussion, I suppose, but about valuations and the US interest in healthcare in particular is bidding up values, particularly in the pound being low. Pound's low again now. Well, that's a bid up prices, maybe a question. The middle column there, a lot of VCs were starting to go into smaller kind of deals, although maybe funding them with larger amounts, but earlier stage business they might have done before to try and catch business early. And that may be a trend that maybe we can see in the panel, maybe reversed. And some VCs thought because of that they were encroaching on the angel space. So again, you've got this issue within VC. One of the things we find interesting enough is that entrepreneurs tend to think if a VC's invested in a business like yours, they're going back yours. And I used to have this a lot when I was at Amadeus. We had these conversations with folks where we'd find in fact that if a business was too similar to one you already backed, you won't back it. You have what's called a keiretsu, more of a kind of a complementary business type of investment process. So there were some interesting trends that came out. You'll see the report that talk about that issue about whether how close the businesses should be amongst each other that you're going to go and back. And then there were some hot sectors identified, some seats to the front, but maybe no one to the front, all too frightened. So there's some of these trends, some of these sectors have continued to grow through the last couple of years. Some have ebbed a bit, we'll see. And the interesting question is going to be failure rate. So the adoption, the acceptance of failure within portfolios, the newer the VC funds were, the fewer failures they had, and obviously there were fewer failures when funding was more prevalent. So the question is going to be what happens now as things get a bit tougher, and that may be something we may be able to discuss with the panel as well. So sorry, the line has gone straight to the middle there, but the mean was, at the time, was 12%, which is a very low failure rate for VCs compared to historically. And there's different definitions of failure within VC, whether a business grows enough or it gets closed down, or whether it literally fails. I just want to turn to a couple of bits of insights about what happened then during the pandemic, and then we'll sort of get close to the discussion process with a few thoughts from John Finmore, who's got me here for us as well. So we work with lots of these universities around the world. Boston University in Boston is one of our partners, and they went out and interviewed VCs a couple of times, including very recently. If you go on our blog and our events page, you'll be able to see a video from an event we did on April the 7th with Boston University, where we went out and interviewed further VCs in the Boston market, and that's a market that's focused on healthcare, fintech, and services. And healthcare, I think BioNTech is based there, one of the founders of the vaccines for COVID. But they went out and interviewed a bunch of VCs about a range of things, but also picked up a number of anecdotal tips, which kind of relate a bit to where we're at now, although we're probably more of a hybridized world. So everything was kind of being done in networking things beforehand, then it sort of closed down to the Zoom world, and it's kind of become more of a hybrid model effectively as an industry. Interesting enough, at the beginning of the COVID period, deal flow collapsed, and then it kind of came back, and it roared back a lot in the US with the IPO market, and obviously the IPOs of DoorDash and Airbnb and those kind of businesses in the US drove that huge growth. You had the rise of SPACs, these alternative ways of raising funds, which came up. They've probably gone away a bit now. They probably won't come back for the moment, but that was a different way of raising money. Valuations initially took a hit in that process. They've come back, obviously. And the deal closing process. So I was at a conference in North Carolina the other week, and VCs, I know some of the panelists here may disagree, but VCs there were saying they're working 24/7 in the US to close deals and to work on deals and get deals through so they didn't miss out on deals. And one of the effects of the market easing or market falling slightly recently, the public markets, has been a more sort of 9 to 5 kind of approach. And they said, actually, a number of VCs said in this panel that I was on, that they are doing deals more slowly. That whole pipe is therefore slowing the whole process down. Speed to market is not so important anymore. Maybe there's more due diligence being done, etc. But they said an average deal is being done a month or two. Now they're taking sort of 3 to 6 months. That sort of gunges up the pipeline effectively. So that was kind of a part of the process. There was one other slide here. They talked. The team actually also asked VCs about the nice American word, the kinesics of the startup team. They looked at. They said basically, obviously, historically when you pitch VCs, you've gone in. Once you've got through shortlisting and then you actually arrange a meeting if you can and then go and pitch the VC, historically it's been done in person. And from my perspective, working in the sector previously, that really does make a big difference. This quote here from an incubator director in Boston, no substitute for looking an entrepreneur in the eye and making him or her sweat a little bit. I don't think these guys make anybody sweat, I'm sure far too cuddly this lot, but it's kind of, it's the idea of being able to watch people in a in-person environment. You can actually try and see and ask questions perhaps differently than the Zoom type process that was being used. So a lot of deals being done in the US in particular were done in Zoom, and they're still being done on Zoom to a great extent in the US. So that seeing how those teams work together, and obviously if you're backing a team, you want to try and see how they work together, and push them a little bit. That's not so easy, even if you've got multiple people on Zoom. That wasn't so easy. So that was quite an interesting effect. So at the moment, the most money going into the sector, the most deployment there's ever been effectively, people making decisions where they hadn't met the people individually, and that may have some of the reasons as to why things are slightly correcting now, but also some longer term issues. There was this acceleration to funding and to pitching, because what you see is that there wasn't a requirement that you get on a plane and go and see somebody, etc. And we'll see there's some quite interesting kind of nuances have occurred since then. Even the last few months now, that have now changed again on that. So just very quickly before I go and introduce the panel in 1 minute, if you go onto the website, the Qodeo website, there's a blog. There's lots of stuff to learn about the industry and about how to pitch and how to get in and issues for. We've got a great article there from Stephen Fusi, who's a professor down North Carolina, who's one of our hubs we work in. talking about issues for African American entrepreneurs. We did a great Women in Venture event about a couple of months ago now, which we put together, and we had a range of really interesting venture capitalists. We had one in Florida, one in Switzerland, Zurich, a couple other venture capitalists, female venture capitalists and female entrepreneurs, talking about issues about access to capital and problems they've had, etc. there. So there's a wealth of knowledge there which you can try and get. If you go to Qodeo.com, and some of us are in the room, some of the board members here have QR codes on their phones. You can actually sign up really easily as well by just scanning our QR code on our phone today. You can get in, and it's from £9.95 a month or £20 a month, depending on which program you sign up to, usually for Qodeo. But there's 50% off if you use this for Qodeo Concierge, which is this process where we actually give you feedback on your profile and make you more matchable as a business potentially. So welcome Monica, who's been on the door there, helping people come in. You get 50% off this Wow Qodeo coupon or voucher at checkout, and we'll remind you in the email tomorrow. So before I just come onto the panel just very quickly, I wanted to just mention, so John Finmore from CMS was going to join us, and said he couldn't join us because of his family, unfortunately, getting COVID literally today. And he gave me some thoughts about where he thinks the market's going. We might sort of web that into the discussion with the panel. He just said, just as thought pieces before we start, might sort of provoke some conversation on the panel. And he deals with VC deal flow. He does deals for entrepreneurs working with VCs. He said the market is showing signs of it's still showing signs of activity. So some people would be very concerned recently, is VC over like the 2000 era? And very much what we're seeing is there's a slowdown, and the valuations are off slightly, particularly later stage or on the earlier stage. And what John said here is we're seeing term sheets coming for new rounds in the seed and Series A and B levels. Term sheets for later stage deals seem to be harder to come by. So that's kind of interesting trend we might want to talk about with the panel. He said we've seen some competitive processes as well, 2 or more term sheets for the same deal. And he said SaaS remains the hottest sector that they work in. So it's a subscription type business like ours. And we're seeing valuations cool off a little. The types of valuations in 2021 do not seem to be happening again. And it's also true they're seeing less deals from US funds, and we'll come back to some of these trends in a minute. So there's some initial thoughts, sorry to run through very quickly, that John, who would have spoken today, was going to raise. Perhaps I could welcome the panel up, if that's all right. So I've got John here, John Lerner from Spencer Capital, got Will Ord from Conviction VC, Sanjit Dote from Outward VC, and Ben Matteo Scarabelli, try and get that right, who's also going to join us, who's from L Marks. So if it's okay, what I'm going to do is ask these individual folks to introduce themselves and a bit about their backgrounds and what they do. Then I've got a few questions for them, and then we'll open up to Q&A. Just been asked by Monica also to mention that if people want to email questions to team@qodeo.com who are online, then they can send in questions. But I know there's also a chat function on Zoom at the moment. But I know. We did try to diversify, but actually it's interesting because people have very diverse backgrounds, despite all being, it's not quite the same kind of backgrounds in terms of where folks come from. So hopefully they could try and explain. But I know we did try to find a woman VC for the panel, which is a problem because there are obviously fewer women in VC in the industry still, and so when we asked a number of people, nobody was available for today, proportionately. Right. 2 to 3%. 2.3. Yeah, so there's a problem on both the number of women in the industry, as you can see here, and there's also and other communities, like in America, there's a lack of African American VCs. Yeah, it's a much smaller percentage. Yeah, that's right. So and then obviously now it's not always true to say. Interesting enough, before we get to the panel, then interesting question. So when we interviewed venture capitalists in Silicon Valley and women entrepreneurs, a lot of women entrepreneurs didn't want to work with female VCs. And we asked why, and the interesting thing was many female entrepreneurs said that the women who were in VC didn't necessarily kind of have the understanding or empathy for the businesses that they were running or their lifestyles they were trying to work with. And so they actually preferred often to work with male VCs rather than female, which is completely not what we expected. So that's some quite anti-intuitive things when you kind of, so I think that, there are some funds in the US, for instance, when we just did work with Boston University, there are funds that were specifically African American entrepreneurs that run in many cases by African Americans, but not always. But it wasn't always just the easiest, obvious case just because somebody was African American. Unless you back an African American business, they may back another business. And my old boss at the VC used to say, she's a female boss at VC, I won't name her just on the record, but she said, I just back the best entrepreneurs, whoever they are. And she's more recently become to be much more open about trying to back women entrepreneurs as well. But that's quite a recent change, I think, in terms of how one of the most prominent female VCs in Europe views how to look at deal flow. One of the things we look on our platform is the background of the business and whether there's sort of a match there in some kind of way. But thank you for that. So may I just introduce, we'll start with I was going to start with John, sorry, in the end there, and we'll go along the line. Apparently you have to press the red button, if that's right. And maybe John can explain a bit about your background, your firm, and what kind of sectors you do, and I'll ask some questions to the panel once we're finished with the audience.
Hey, John Lerner, I'm a partner at Smedley Capital. I've been there about 15 years now. The fund's been going about 25 years. We're backing B2B businesses, mostly SaaS, Series A and Series B across the UK, the Nordics, the Netherlands.
So Will, part of the team at Conviction VC. We're also a B2B SaaS focused fund, investing late seed, Series A, and all across Europe, though practically to date that's translated more as Northern Europe. I think we've only got one investment in the southern half of the continent so far, and been investing in the VC space for about 10 years now.
Hi, I'm Sanchit. I'm with Outward VC. So we're a fintech focused fund focused on seed and Series A. That's where we make our entry investments. I've been with the fund since we started back in 2017. So we're sort of we're near the end of our investment period for the current fund. We have a few slots open for maybe another 3 or 4 companies before we start investing from the next fund next year. And yeah, we invest in the UK and also in the Nordics as of now in terms of portfolio, but we're looking across Europe as well. Just worth noting, so I said fintech, that's super broad in terms of our definition. So it's really anyone selling into financial services or wanting to embed financial products into their offering.
Matteo from Elmarks. We run corporate accelerators, and the reason we're here, we also angel vehicle, super angel vehicle to be honest. So Elmarks come from Mr. Marx, so it was a serial entrepreneur turned angel investors, and we've done over 40 investments globally, mainly B2B, pre-seed and seed, and globally. So first investment was in Australia, the last one is in India. So we go very early. So, but not through the accelerator. We don't take equity. We do actually direct investments in the startups if we want to invest.
There's a bit of an array of folks here. So I'm going to ask a few questions, and afterwards we'll open it to Q&A from the audience, if that's okay. We had a sort of prep call last Friday, and we had a sort of bit of a chat about some of the trends and issues we're seeing coming through. So my first question about regions, Will, you said you had one investment, I'm not picking you, but you said you had one investment in Southern Europe, and we were in Malta the other week and doing an event like this for Maltese entrepreneurs, and there's a relatively small VC market there. So when we spoke, we talked about I suppose 2 things, one of which was the Europe to UK connection, if that's changed in the last few years, and what the nature of the entrepreneurs might be that's changed from Europe. Maybe start with Will and go to some other members.
Sure, happy to comment on that. I suppose kind of particularly on the post-Brexit Europe to UK, there are some funds, not us, who have, in particular EIF or other European institutions as investors, where they now have requirements to invest a certain percentage of the fund in Europe. I've heard kind of other VCs say they need to deploy 2/3 into Europe. If they also want to deploy some into the US or into Israel, then it starts to squeeze on how much they can deploy into the UK as a fund. From our point of view, we're a relatively small team. We can't be present in every hub or outside of every hub physically in person all the time. So the team's based out of London. We obviously have a strong network here. We can turn up to in-person events and meet entrepreneurs in person. We have to supplement that with either referrals from other VCs or investors that we get to know in Germany or the Nordics or other countries, or just direct outreach or direct inbound, which is usually data-driven, to try and find entrepreneurs in other places. But when you look at the stats for where unicorns are created in Europe, there's a lot of unicorns coming out of the UK and Germany and France. there's plenty of unicorns coming out of absolutely everywhere else across the continent as well. There's no monopoly on the creation of good companies in the capital cities.
And what about, maybe to answer other members of the panel, so when we spoke the other day, there was discussion that it used to be that a lot of entrepreneurs would come here and just be entrepreneurial and start up with an idea later, and now it's more that it sounds like they're more fully baked opportunities. Maybe Matteo, first of all?
Yeah, I, as kind of, it's okay with the mic. As a European, I've seen lots of funds investing. So yeah, it's not working. But anyway, European is now more in EU anyway. So yeah, so many European countries started with funds of funds, so to basically activate more early stage investments locally. So while 5 years ago, many entrepreneurs from Spain, Portugal, Italy, wherever, they were simply flying here, setting up an LTD and just try to raise angel investments straight away. Now is a bit easier locally, but I think that's still a good deal for the UK investment scene, because historically UK funding market is more specialized Series A later stage. So as Simon was anticipating, so we get more kind of baked deals, off-baked deals with a local market validation in another country, but so probably a bit smaller deal flow but higher quality. So this is what we've seen over the years as an evolution.
Okay. And Sancho or John, do you want to comment at all? Sorry, get the microphone.
So I guess the initial question was around access as well, right? In terms of how do we? So, look, I think most VCs will tell you we all operate as like pretty small teams, right? So can't be everywhere at once. But post-COVID, once COVID kicked in, I think Zoom has massively helped in terms of breaking down those barriers. Because one of the things with Zoom is, right, you don't get that in-person interaction, but actually, if you think about it, you actually end up spending more time on calls, on Zoom calls. It's quicker to arrange. You actually spend more time speaking to the person on the other side of that Zoom call, and that just helps break down some of those barriers in terms of like particularly regional access. So we've seen the proportion of our deal flow go up in terms of what we're seeing vis-a-vis versus London, but it's not purely because of that, but that's definitely a sort of contributing factor. And then obviously the other trend is people setting up remote first companies as well. There are a few success stories out there. I think that knowledge is now filtered down to entrepreneurs on the benefits of that as well. So again, we're less bothered about where the business started, but sort of where it's going in direction of travel.
And perhaps John, if you want to add to that, and maybe perhaps a little bit about the access to capital, because obviously it's a theme for us in terms of how we can all help. And obviously our platform, in our view, is a way of collapsing down some barriers, but how we can all help to make it more easy for entrepreneurs who haven't historically had access to this funding mechanism to get access to that, particularly from across Europe, from regions, as well as diverse communities.
Yeah, of course, I think I'd echo what other people have said. I think it is easier than it's ever been to talk to VCs, because I think first meetings are typically via Zoom, which made it much easier for people in remote locations to be able to have those first meetings with VCs. People have said many times in many different places, you will need to speak to a lot of VCs, even with the help of a brilliant platform like Qodeo. Like, you'll need to speak to a lot of VCs to get the match right, and it's much easier to be able to do that remotely than it is to have to try and do it face-to-face in person. So I think the bit that's missing is making sure that people are aware of what the funding opportunities are, particularly for people who aren't in the scene, in inverted commas. That's where I think we can all help make sure that where there are entrepreneurs, they understand what the options are available to them and they know where to go looking.
And from our perspective, very much to sort of help shortlist that process so that people come to market faster and more easily and kiss the right frogs effectively in that process. I mean, one of the things we found with our concierge product, interesting enough, has been, particularly in remote markets, so we've had entrepreneurs in India, in British Columbia, across Europe, etc., in places which aren't the obvious funding locations. is in almost all cases, rather than overblowing their story, the entrepreneurs build their profiles, and this happened with regional and diverse entrepreneurs in particular, they undersell their story. It's quite interesting. So we've seen that people are asking for too little money, they're raising at too low a level, and then they're surprised they're not getting enough interest from VCs. But actually, and we can't rewrite people's decks, we're not advisors as such, but people often ask for too little money, they value their businesses too low, sometimes they don't talk about what they really can talk about. And when I went to business school, one of the things I learned was to make what I thought was implicit, explicit. And to many entrepreneurs, they just implicitly think there's something great about their business, or you would understand what is out there, and you wouldn't necessarily know unless you shout about it. And so it's fascinating how the more remote you go, the lower the expectation is. So when we were in Boston and did this project at Boston University, there was the title of our report in Boston with BU, it's called Searching for Horses, Not Unicorns. So in Boston, which is in American terms a semi-regional market compared to New York or the Bay Area, most entrepreneurs were thinking about building aggressive growth businesses, which might exit for $200, $300, $400, $500 million, which is a great aspiration potentially, but not the unicorns. And that was even Boston versus New York.
Yeah, I'm going to be controversial now. The whole market, it is my belief, has become far too unicorn focused. It's become unicorn focused because the valuations went to a point where the returns could only work if you were only focusing on unicorns, because you were raising at such a high valuation at such early stage, which if you were an entrepreneur that happened to get on and stay on a unicorn track was a fantastic thing. For the other 99.999% of entrepreneurs, it was a bad thing. Raised too much money, tried to be on a track that wasn't necessarily the right track for their business. And I think there'll be a lot of entrepreneurs who've missed out on some fantastic, dare I say it, £50 million exits. Because let's be honest, if as an entrepreneur you start from nothing and build a business worth £50 million, you have achieved an incredible feat, which most people in the world will never go and do. And we've become a bit of a cult of the uber winner, which is, I think, to the detriment of everyone in society, to us as VCs, to the entrepreneurial community, but also to all the other stakeholders in that business, those businesses. So I'm actually really looking forward to slightly lower valuations, to be able to create a fund construct that says you can have businesses you're backing, you're expecting to exit a couple of $100 million, that will give the fund the returns that our investors are excited about, and that those entrepreneurs can be truly proud of.
So we saw in Boston, the VCs are more focused on horses and unicorns as well. So they had less expectation than potentially some of the Bay Area or New York VCs might have. That's fascinating.
Just on that point, it's really interesting, right? Because that sort of mimics the US mentality. We talk about the US mentality a lot, right? About chasing unicorns and all that. The US market is massive. The North American market is massive. It can support multiple unicorns, multiple businesses. We can try and imitate that all we like here, but the reality is we are a smaller market. Europe is not a uniform market. There's multiple different markets within Europe as well. So I think there needs to be, I completely agree with your point. The one good thing, however, on the flip side, is there's more funds than ever for entrepreneurs, right? So there's more funds that have been raised. There's more entrepreneurs that have left these unicorn companies, have started their own businesses. So there's been a lot more recycling of capital. On the whole, I agree with your point, but I think that's the sort of benefit that maybe we should take out of it.
So interesting on the US side. So when we also talked about that there has been a sort of an advent of, same with VC, but advent of or the arrival of lots of US funds in the last few years. The Americans have been coming, and American funds, probably the top 10, 15 US firms, established some kind of bridgehead over here, and they seem to sort of bid up prices and potentially crowd out some of the local VCs and bid up valuations in so doing, which overinflated the UK market potentially, and now there's been a bit of a potential withdrawal. Would anybody like to comment on that at all?
Just formal. So yeah, I think in a word, yeah, it's just like they created this, like you couldn't miss a deal. So and yeah, that creates a. I don't want to use the word bubble, but practically speaking, so that was happening last year. So now we're kind of going back to we were saying earlier, like normalized situation. So like, and this is a good thing, I guess, both for the investor world and also for the entrepreneur world. At least you know your business is valued on business metrics, not simply on like how many people are willing to give you money just because they don't want to miss a deal. And you got investors on board who are actually keen on helping you grow in the business, the team, fundamentals, and everything else, unit economics. But last probably 18 months, it wasn't like that. So, yeah.
Any other comments, panel about that? Or?
I suppose if you think about it selfishly, as a VC, we all want to have minimal competition at the point that we're going into deals. We want to get in on the most favourable terms, and then we want to turn around and help those entrepreneurs to raise super competitive, highly valued rounds afterwards. Now, I totally get what John's saying. On the other hand, sorry?
No, I'm just wondering, like, are you like going somewhere beyond that unicorn kind of context? Are you trying to, like, are you serving actually the market, like underserved? Are you serving the market with your capital? Like, are you trying to deploy capital into some of the served like sectors, this maximal income? Or are you still into this unicorn?
I think perhaps
I think
give
no, I don't know.
to give Will a fair chance to answer back. I think what he's doing is giving us into the marketplace, how it's changed on a
But I
macro
suppose
level.
Picking up particularly on your point, and this is probably a theme that's much more common in SaaS than it has been in other areas, it's not just about building businesses that grow the revenue or the top line, which can in many cases be a vanity metric, is about the fundamental profitability of the business. I mean, what we're looking to invest in are businesses that will be enduring businesses where they're delivering fundamental value to the customers, which means they have a core profitable loop in it, where the customers are worth more to the business than it costs to acquire them, which means that you don't raise huge piles of cash in the hopes that when you get to scale, your economics will suddenly flip round and you'll become more profitable, which is the model that kind of WeWork or Uber or Gorillas have all followed, and one that we will probably see fall out of favour a lot in the coming year. Those are probably some of the businesses most at risk in the current market contraction, because nobody's willing to pay up for kind of pie tomorrow. Everybody wants to see that there's a steady core underlying business that grows because of the value of the product you're offering today, not because you're offering something at a fundamentally lower price than it's worth.
Obviously, I mean, the counterpoint to that in VC is obviously you get the returns. So there needs to be a growth mode and mentality, as opposed to sort of trying to grow more. So there's been this tension between putting more capital in and growing faster, but it's not growing that fast. If you don't grow fast enough, you won't grow the business big enough to have the valuation to get the return. So it's kind of a bit of a sort of double-edged sword, effectively. Can I ask, I mean, one of the other interesting questions? So again, when it goes back to the concierge issue we have in terms of these entrepreneurs, something we work with, someone is not actually fundamentally valuing themselves or their businesses sufficiently, particularly those from regional diverse backgrounds. One of the things that we were talking about also was due diligence. And many of the entrepreneurs haven't had experience of obviously going through a due diligence process, because that wasn't as necessary potentially in the same way, same rigor in the last few years it might be going forward. So how can those entrepreneurs prepare for that kind of process? I think John has something to say about that.
Yeah, I think the last few years, it's been a trend over 5 years, but certainly the last 2 years, due diligence has become lighter and lighter as the market's got more and more and more competitive. And I think we'll see a reversion to a more normal process where there's longer for entrepreneurs and funds to get to know each other and for the due diligence to be done properly. I don't think there's anything to be scared of or to be worried about. I think if you run the business well and you have a deep understanding of all the different metrics within your business and you can articulate them well to an investor appropriately for the stage that you're at, which is clearly different if you're at seed stage than if you're at B or C stage. If you can do all of those things, then the due diligence is not something to be worried about. It's just something that you need to prepare properly for.
You were saying there's been a change in terms of potential and so about the philosophy of due diligence.
Yeah, look, I guess if you're an entrepreneur, then it's sort of changed. So while you previously, so when I say previously, I mean last year being a record year, 2021, you spoke about 2019. The whole fundraising process was sort of narrative based, right? So you're selling a growth story and selling a vision and yourself and the team and everything else, and that sort of worked at seed historically. It worked at Series A. It was working at Series B when all these US funds were coming in. I think that has like quickly flipped now in the last few months, and we're back to a level where we're evidence based now, right? Where there's actually assumptions that sort of need to that you would need to back that up. I mean, John was saying like we were talking about this earlier. There's a whole generation of not just entrepreneurs but also VCs, right? There's so many new VCs, there's young VCs, there's new VC funds that have only known a bull market, right? Have only done due diligence in this sort of compressed fashion. But I think what we're going to is definitely more of a normalized environment.
So there's probably some education process around that, because obviously people haven't gone through that process before, don't necessarily know what to expect.
Yeah, I think, look, as I said, what normal means is that people are actually looking at what your projections would be, your revenue assumptions would be, what your cost base looks like, and how long that actually lasts you from a runway perspective. Whereas, in previous years, you probably had a situation where people assume that you would then raise another funding round in the next 6 to 12 months, which is not guaranteed anymore.
So comment, sorry.
So I would just follow up on that. The bit that I think is really important to bear in mind on the due diligence process is that it's a two-way street. And for entrepreneurs, when they were running these really tight timeframe processes where people were dropping term sheets sometimes within a matter of hours or days on them, there's very little opportunity for them to get to know the investors that they were taking money from, other than, hey, they've got a massive war chest. But the inverse of having a massive war chest means that you're a very small portion of that war chest. And it's really important for entrepreneurs to understand the pain that will come their way if they fall out with an investor and the investor thinks there's a different direction for the business, or decides not to back them and has a signaling issue that, hey, these guys invest at Series A and Series B, why aren't they following on into your business? So take the time to take out references on investors, talk to other CEOs that they've backed before, understand how they've behaved when the goings got tricky, not just when things have gone swimmingly up and to the right. And that investment of time and effort on doing diligence on your prospective investors will pay off. And it's much better to have investors that are well aligned and want to back you as the founder than to just maximize for the highest headline valuation term.
And again, come back to the Qodeo thing, obviously our angle today. When you go onto Qodeo as an entrepreneur or as a VC, when you look up different profiles, we have a standardized dashboard kind of system. So if you have a short list of a certain number of VCs you want to actually go and talk to, VC or PE firms, all the metrics, all the information is presented in a similar standardized kind of way. So you can look through those profiles quite quickly, see some of the key leading portfolio companies, and again, see what they look like and potentially try and reach out to those folks. In fact, through the messaging capability, though that's used less by entrepreneurs, there is an opportunity for entrepreneurs to contact other entrepreneurs on our system, as well as entrepreneurs trying to reach out to VCs. So that's something we're going to actually try and promote a bit more, because that networking effect and that feedback is useful. Can I just come back to maybe one final thing before we talk? There's much we could talk about, but I do want to open it to the audience in a minute. But I want to give a very interesting trend that's just emerging, also very emergent, we call it that, which is that when we spoke last week, there's a very interesting case that maybe Sanchit can talk to a bit today, of a company called Vauban. It was a capital management, capital structure management sort of platform effectively, and they went through various raises with you folks, and then got to a certain point when there was a choice as to whether to raise further funds or to do an exit. And obviously, exit's always the point in venture anyway. Anybody's an angel investor or a venture investor looking to sell the business at some point to realize what they put in and get some kind of return potentially. But historically, businesses go through many rounds in many cases, and the exit would happen late, maybe after several rounds of investment, maybe through an IPO, maybe through a trade sale, wherever it might be. All of a sudden, there may be the emergence, it looks like, of earlier in the process, trade sales to a trade acquirer instead of future venture rounds. And you've got an example you may want to talk to about that, and then we'll open it to the public, because that's a new trend we've just seen emerging recently.
Yeah, sure. So I think before coming on to the specific example from our portfolio, I think we will generally see a trend of M&A in maybe a couple of buckets. So one, more opportunistic M&A, because there may be well-funded startups or corporates or other larger players out there that may see startup companies running out of cash, right? So it may be a good time for them to pick up an asset and a team and everything else. On the flip side, you may have another example, which is sort of Vauban sits in that bucket, where it may actually make sense for a startup to team up with a larger business to get to that sort of eventual goal of where they want to get to. So the Valband story is very interesting. We invested in this company about 15, 16 months ago, so not very long at all. That was our entry investment. They were on a roadshow with investors a few months ago. They actually had a couple of term sheets from a couple of sort of Series B investors, and at the same time, Carter, who's a big sort of US VC-backed player, very large balance sheet, sort of came in, and that's when the discussion started. And I think the thought process there was Valband have a very, very big mission. The team there is like, you know, have this ambition of building a huge business. And the question they had to ask themselves at that point was, okay, we're at a point in the market where do they raise multiple rounds of funding, actually get diluted as founders, us get diluted as investors along the way, and reach that end point and sort of build things that where they will inevitably run into competition, or would it make sense to partner up with this big player that will instantly sort of give them scale on their existing products? And yeah, that was and sort of, you know, that was the thought process that went on, and eventually they sort of, you know, went with the option of sort of sitting and partnering up with the bigger company there. So and that deal was done pretty quickly as well, like and it was a good outcome for all parties in the end. So happy.
Thank you, Sanchit. John wants to say something.
So I think there'll be another category of there'll be some overfunding in sectors where multiple competitors have been funded, and there will be more and more of them merging together. I think we'll see that the money won't be available for them all to follow on. Maybe there didn't need to be that many businesses funded in a sector. Sometimes there won't be a clear winner. You saw it with Crowdcube and Seeders trying to, they're both done very successful businesses, neither had got to the point where they originally wanted to get to in terms of, I guess, getting the VC returns they'd hoped for. And so they tried to merge. Actually, that's a sort of a slight tale of woe for the UK, because the two European leading businesses both have to be based out of the UK. Could have been one single European leading business, and the Competition and Markets Authority decided that was a bad idea somehow. And so they blocked that merger, even though you've got two businesses with circa 5 million of revenue each, give or take. It's a slightly crazy thing for them to get involved in, and a bit of overreach from my perspective. And that will mean that the UK doesn't have a really large force in that space, which it could have done. It'll have two slightly smaller, weaker forces that will find it more difficult to get over the hurdles they've got, which is, given the UK has led the way in that market, in the crowdfunding market, it's a shame.
Counterpoint. So if it's okay now, what we'll do is open up the floor. I know Monica sent me some, my colleague here sent me some texts with some questions coming from online, but I just wanted to, first of all, give the opportunity to thank the panelists, but we're not finished yet. We're going to get some questions to you. There is food and drink for after this. I'm keeping an eye on the time. But if we want to open the floor, first of all, to any questions, if you can say who you are, your name, if that's okay, where you're from, in terms of organisation, or if you're setting up an organisation where it might be, and if it's particularly want to ask a question of particular people on the panel, but otherwise more generally. So there's one here, Barbara, I think. You want to stand up, perhaps, maybe, if it's okay, if it's stand up and say who you are, and should be a microphone, or you want to, no spares? Or a mic. Yeah.
Hi everyone, I'm Barbara. I'm a founder of Remote Bob. We are revolutionizing how entrepreneurs are collaborating with virtual assistants. And I did my executive MBA. So far I was bootstrapping business, consulting about go-to-market strategy. And now we reached the point where we are going to fundraise for the first time. And it's actually after a long time that I'm doing something new. So we got approached by one big brand, by one angel investor, and by one VC. And now, as you mentioned, it's similar like dating. So for last couple of months, I've been like thinking like one person is bringing a bit more of mentorship, one person is bringing a bit more like due diligence that will help us in later rounds. So I'm kind of thinking too long. So I want to hear what's your perspective. Like, should I just go for it and make a decision and do something fast, or should I just take my time and try to find the perfect fit?
Happy to jump in some first thoughts, and I think the first and most important thing to say is that you can't go back once you've taken VC or investor funding on board. So it will come with a set of expectations as to where they want the business to grow to, based on what kind of returns they want to get out of it. And look, as John said, in many cases, VCs have probably driven businesses to grow at an unhealthily fast pace that has caused them to take on more risk than founders might otherwise wanted to do. So I think first up, you need to work out if it's right for you on that scale and think about where you want to take the business to and align it with that. Most founders don't have the luxury of taking that time, because most founders are in a loss-making position where they need to get cash on before a brick wall hits the end of the runway. But if you've got the luxury of time, kind of, if you're not comfortable it's the right investor, there are many fish in the sea. So talk to other people as well.
One of the things we do on our platform, is that we grade the matches on the system. Now, it's based upon the data we have on the entrepreneurs and the VCs on the other side. So it's not perfect, and so we're getting there. But the idea is trying to work out who the best fit might be for you, and it's again very similar to that sort of dating analogy. So, and it might be as your business changes, that fit might change. So if you're raising more money, you might be in the VC space. Raising less money might be in the angel space. Could effectively be the same business. This might be progressed in a different kind of way or different kind of stage. So that, it's useful to try and focus on who you should speak to at that time, or you can work collaboratively between angels and VCs in many cases, or set up in different stages. Does anybody else in the panel want to answer? Too frightened of the exploding mics?
Just a very simple rule of thumb. I mean, if you're happy to meet this person on a quarterly basis for the next couple of years, that's usually a good indicator. So like, if the sensation is already like, yeah-ish, I mean, good skills, good something, but I wouldn't be happy. I don't think they will support me in good and bad times. Maybe in a year time, that I would go with a no. So like, because the role of the investor is, it's clearly we're serving the LPs, but at the end of the day, clients is the startup. So if they're not able to help you navigate, not only the good times that we live through the next 18 months, but also the struggles of hiring, future fundraising, like problem on co-founders, everything. So you should have at least, like dating. So
I mean, the dating analogy is interesting. So we found that the average British marriage lasts less long than the average VC to entrepreneur relationship. So you better get on. And divorce is actually harder in VC than it is in other realms. So you need to try and work out who you're trying to work with, and also the chemistry between those people and the chemistry going forward. So, sometimes there might be angels who haven't got on with certain VCs, or there may be some sort of other sort of track record. So you need to try and do your due diligence on the investor. That's how we try and help you also, not only with the grading, but also looking at standardized dashboards to understand who the people are you're looking at and what kind of business they've backed before, and is there a match. And we do also actually on our platform, we only allow on VCs who either interviewed or they've been put on by us in some kind of way, or they've come to the platform and then been validated. We have a sort of 5-step validation process to allow VCs in who we don't know, because there are lots of flaky type VCs out there that we've had people trying to sign up to our platform who claim they're VCs, and when we then do our multi-step check, we found they actually haven't really been true VCs effectively.
Yeah, just go to the VC's portfolio page, see who's raised the least money, contact them and ask them what they think. Simplest way to get the best reference.
Okay, any other, sorry, Umar?
Thank you. I'm Omar. I'm an ex-global VP from Unilever, so I had a lot of corporate experience and a second-time entrepreneur. So my question, I have two questions. I have a B2B platform, commerce platform. We've been bootstrapping, growing for like past 31 weeks, and we got some of the angels, and we raised 2 safes. So first question is safe still a good idea, right? Because that was easy. No one really asked us a lot of questions. We showed a few Excel files. It was easy for us because we didn't have a lot of data, right? No data rooms were made. So that's one question. Second is, now recently, I'm pitching to a lot of VCs in Dubai and Singapore, and everyone is asking me, raise more, right? Times are tough, raise more. And I don't know what's the right number, because I was looking for like what can I deliver as a GMV in 12 months? And is that going to be, and that's what I want to go for. But they're saying time is tough, right? Like you guys were talking about earlier, right? Don't go for a unicorn, like, so what's the right number now, right? So two sort of questions. Thank you.
Perhaps before we answer that, also two quick points, one of which is maybe one of the panel who answers can explain what safes are, because a lot of people here won't know what they are, and a lot of people online won't know what they are. They're commonly used in the US and less so here. And obviously globalism is interesting because you are getting different trends, different places. And when we had this event at Boston University in April, one of the VCs in the panel actually said, he's a biotech VC, said he's now telling entrepreneurs to raise more money, not less, even though that means that they're diluting slightly more because of inflation. Things are costing more to do. Some things might cost less to do, but all kind of stuff like, telephone bills, legal bills, accounting bills, everything's going up 7-10% at the moment. Well, salaries are up and down a bit. It's kind of interesting because if the tech world slows a bit, there might be a reduction. But maybe comment to come there.
Yeah, happy go. I mean, so the thing with safes is, right, it was always designed, I think it was made popular by YC, unless anyone disagrees with that, and the reason for that was it was always designed to get quick money in, as you said, right? So that's your use case, but at that number is a kind of a bit of a black box, right? People just stick a number on there and then it just kind of goes. In the current market, I think yes, it would be my inclination in terms of it's still a good way to get money in because people still understand it. It's universally, it's universally understood. It can appeal to investors from wherever, right? So I think that should work in your favor. I think what you need to focus on is like, don't optimize for that number, or which is the cap or the discount or whatever it is, right? Use the instrument as a way of incentivizing the investor to get a quick deal done, but perhaps, don't obsess over that number because as we were just talking about, that number can change very quickly, and you have to think about it in the long term. Think about the bigger pie, not just the immediate sort of valuation figure that you can achieve from that. That would be my initial sort of thought process.
Yeah, how much should you raise? I mean, always that's a mix of what valuation are people going to give you and what can you sensibly do with the money. And that's an iterative process. I think over the last 12 months, the answer has been very, very high valuations. So you should raise more, and almost valuations have gone up, or amounts raised have gone up as a function of the valuations. It's sort of been back work to, well, we think we want 20% of the company and we think you're worth X, therefore here's how much you should raise. And I think that's obviously an odd way to drive valuation because valuation should really be driven off what the company's worth, given what it's achieved to date. You'll have to test the market. I'm surprised there are still people saying raise more will give you more because mostly the market has moved to a little bit more, valuations come down, raise a little bit less. I think I agree with everyone from it will cost more going forwards. That's likely to be true. I think wage inflation is an interesting one. Tech wage inflation, who knows where that's going? It's still going up quickly is what we see from the portfolio companies, but we also see lots of tech layoffs. So at some point it feels like that market will normalize. There is so much money gone into the tech ecosystem from VCs and from corporates. I haven't seen any good data on what the net of all that is, the layoffs versus the new jobs being created from the billions of VC dollars that are going in. So it will take a while before that really comes through. And my guess is the tech recruitment market is going to stay tight for a while. So yeah, I think you just need to sit down and work out I think what I normally say on how much to raise is, are there some real pivot points that you can pick up in your plan? And what gets you comfortably to the next pivot point and past it that's going to increase the value that means you can then move on to the next? Or can you get to break even? If you can get to break even on this raise, then that's always the place to be.
The next raise can be like not as soon as quickly as it used to be, right? So raise for a bit longer, right? That's what I've been.
Yeah, I think that's right. I think you do need to raise for longer now than you were thinking of before, but you probably want to burn less money along the way. So how that nets out, I don't know. People are really focused on burn multiples. The appetite, and I think someone on the panel said it before, the appetite for companies burning money very quickly has gone down. So A16Z has written a really good thing on something called a burn multiple, this idea of how much money you're burning versus how much new revenue you accruing. Yeah, if you're more than 2, you're in a bad place, and lots of businesses are. Now that's a bit of a crude metric because clearly for a business at 1 million of revenue, it's not the same as the business at 20 million of revenue in terms of where the burn multiple sits. But yeah.
Any other questions? So Monica, do you have a? Oh, you got the mic. Again, if you can say who you are and where you're from, and then I'll ask the panel. Thanks.
Hello. My name's Oliver Larholt. I'm from My Finance Club. We're a B2C platform that has changed the cost and the speed of lending quite remarkably. Getting in contact with VCs has been almost impossible. I mean, we've even subscribed to your platform and we get matched, and then there's a switchboard number. It seems incredibly difficult to find the right person to speak to at a VC. We're completely cash flow positive. We have more customers we know what to do with. We're rolling out in India with a JV with a local bank because we can't find VCs to speak to fund us. It has to be JVs. In fact, the only place we found funding was literally friends of friends sitting outside at George having a meal or whatever. Getting into this VC community seems almost impossible. And we make, to be blunt, shitloads of money. And we're a fintech. I mean, you know, that's fairly unusual. It should be easy for us.
Can I ask you, what's your method of approach been? Like, what have you tried?
We've tried middlemen, we've tried cold calling, we've tried emailing, we've tried literally picking random names off websites at VCs and emailing those people directly. We've tried Rocket Reach. I mean, it's literally had to be friends of friends. And it seems, unless, you know, if you worked at Deutsche or Goldman's, then you know someone inside the firm who does an introduction, etc., etc. For everyone else, it's tough. Now, that's what I'm hoping your platform's supposed to do, but we're still, as I said, getting switchboard numbers from the matches.
What our platform does is actually ping VCs, but we ping them less often than we used to because they don't want to be pinged too often. So we ping them with matches, and and then some of the VCs in the platform enable contact to be made by the entrepreneur to them. And then it's up to the VC if they wish to take that up or not, because we want to try and not bombard them with too much noise, because they want too much noise in the system. One of the things we're doing this messaging tool is making it a bit easier to make that connection work. But VCs certainly don't like emails coming from over the transom as such. Sorry, John wants to say something.
I'm not sure I agree with that. I think all VCs want more great deal flow. What they don't want is more rubbish. What they do want is stuff that's well curated to them. I think we always, and I disagree with this idea that it's a club. I'd say the vast majority of businesses we end up talking to have no connection to us and not referred in from anyone who has a connection to us. Obviously there are some, but most of them are just, they're either people we've reached outbound to because we've seen some impressive stats about their business, or they've reached outbound to us because they're interested. So I think I'd probably, if you're not getting any response at all, I think, you know, very happy to have a chat, but I suspect that maybe either the selection of the VCs or the messaging that's getting across to them is not landing well. And I think our industry is very guilty of not replying to everyone. We try and reply to everyone. It is not always possible. You know, points where the deal flow is strong and things clearly don't fit, to a point where it says on our website where we invest and this is a completely different business, we just won't reply because we can't reply. Everything that fits broadly within our mandate, we try and reply to.
We just want to check there might be something else. We've got a limited amount of time, and sorry about this. And we've got 3 people here. Sorry about that. Maybe after in the break afterwards. So Shana down there, I think has a question. Maybe after that, then we'll come back to break.
Hi, I'm Shayna. I'm the former moderator for avc.com, which I'm assuming is a site all of you have read. I do marketing advisory for startups now here in London. I also advise the UK's largest professional military education nonprofit media thing on growth. I've been in growth marketing and product marketing for almost a decade now, and I apologize for this. One of the things that's been discussed very heavily in the field is how there's been the normalization of metrics for SaaS companies, and with that has come the creation of a debt market of taking loans out on your future revenue. How is this changing the fundraising market? And how is this also changing, from my perspective, ad spend?
Yeah, we've definitely seen a trend over the last half decade, particularly in Europe, that venture debt has become more common at earlier stage, and then following the wave of venture debt has come the wave of revenue-based financing, which started off in the consumer market and has now made its way over to the SaaS market. We did an exercise last summer where we had a portfolio company around 8 mil ARR mark, growing nicely, great metrics, and they went and talked to 15 different debt providers of every stripe and color that there was under the sun, and it was actually really hard, both for the founders and for the board, to compare apples to apples what was the best money to take on board, because you had vastly different terms between traditional venture debt models that wanted you to pull the whole lot down up front, take interest at the start, gives them some warranties or options over your equity, versus the revenue financing guys, who's basically a facility that you could draw on as you wanted and scaled as your revenue grew. It's a really useful tool from an investor's point of view when you have well understood parts of the business that you know you can deploy money onto and get it back in a relatively straightforward kind of CAC payback loop, that you can fund that with debt, which is less expensive, and you can think about how the profit from those new customers you acquire is financing the debt versus the equity that is that's driving the more speculative parts of the business. I know also over the last few months from talking to many of the venture debt guys that they're licking their lips, that there were deals that they previously wouldn't have got into in the market that are now trying to extend runway or bring more capital on board, and they're getting pick of the market at the moment in many situations. So it's a really useful tool. It works best if you understand how you're going to get the money back and what it's going to be used for. So if it's driving profitable, well understood growth channels, brilliant. The only downside and the warning that I always say to founders is, if you're too early stage and you run into trouble, it is more trouble if you've also got venture debt on your cap table to extend runway, because you need to pay off the venture debt as well as increase the runway for the business.
Yeah, I just echo that. Like, venture debt is a bridge, and if you don't get to the other side of the river, you fall in the water, and you fall in hard.
Okay, thanks. I think Will actually had a question. No? Okay. Goodness. Andrew in the front, and then I think maybe after, I've got one question that's come through, might summarize from the inbound stuff that's come through my phone, but maybe I'll ask Andrew first of all, and then...
Thank you. I'm Andrew Wood. I'm the CEO and founder of Empathy. It's a B2B SaaS platform that focuses on helping large law firms better monetize their receivables. I've heard you talk a lot about valuation. I'm going to ask you to go out on a limb and put a number on it. My metrics are that I'm looking at a company that we're looking to disrupt, IPO'd last year, 2 billion valuation at a 10 times multiple. It's now worth about a 7 or 8 times multiple. And then, of course, I read about Klarna
SaaS,
in the...
SaaS, you mean?
SaaS, yeah, it's a purely SaaS business. And again, same vertical, lawyers, the odd smattering of accountants. I also obviously read today about Klarna. That's the real. By now, I can't remember what the FT headline is, but if you had to go out on a limb, what would be your SaaS multiple for a sort of fintech professional services B2B type thing, and where do you see that going up or down in the next, say, 18 months, 2 years?
Well, I wouldn't have to go out on a limb because there is data out there, right? I mean, we're looking at pretty much half of what you said, right? The sort of half of the 10x sort of multiple, and that trickles down, right? It's not going to be exactly proportional at seed stage, right? Because when you value businesses at the later stage, you are doing it as a multiple. At seed, I don't know what stage are you at? Are you at seed or? Okay, fine. So okay, so for early financing rounds, anyways, your valuation is usually a function of the level of funding you want to take, and sort of ballpark dilution figure, right? Which I guess would sit anywhere between 15 to 25%. 15 in a good market, in a hot competitive market. Maybe in a market like today, you're probably looking more like 20-25% type type dilution. So that's how I would think about it. It's very, very hard to directly talk about revenue multiples at an early financing round. But yeah, but half that, that's what I would say.
I'll also not give you a specific figure, but just say kind of when you have zero revenue, your limit is founder dilution and what you're thinking about how you're setting the cap table up for the future. When you're investing at the kind of far end of the alphabet soup and you've got IPO in mind in the near future, you're very tightly tied to what's going on in the public markets. And there's a bridge between the two. So you'll typically see seed or even Series A deals get done at multiples that aren't directly connected to the public markets. But then if you're much higher revenue multiple early days, you're going to have to bring that multiple down to get back in line with public markets over time. That gap is now larger with current public listed comps than it was last year. So there's going to need to be more, you're going to need to pull that valuation down further and faster if you've raised at higher valuations in the early rounds.
One last thought, unpopular as this will be, revenue multiples don't mean anything. And that's what the industry is learning again, and it will learn it again and again in every cycle. People pay for profit. Revenue multiples are just a future indication of some profit you might make in the future. And so what people actually care about is how much money you're making and how quickly is that growing. And that's what people will ultimately pay for. Doesn't mean people won't value stuff on revenue multiples. They absolutely will. But this is, I think, where a lot of the panic has come in the public markets about these highly valued SaaS stocks, is people have looked at them, looked at their valuations and said, how much profit do they need to make in order for me to be comfortable, even at the rate they're growing, at that profitability or an EBITDA multiple? And they've gone, ooh, that's a long time away. And that's why the valuations have come down. Because in a rising interest rate environment, that's far more relevant. So I think that's what people will be focusing on a lot.
Thank you. Can I just, so there have been 3 questions come through, and then we'll wrap up and go for drinks and food, if that's right. And you can get a chance to speak to everybody here. I don't know, some of you may have to leave soon, but we got a little bit of time here afterwards. The 3 questions come, they're very diverse. Maybe one person wants to answer each, 4 of you, but 3 questions. We'll choose, have a fun fight, have a competitive bid there. Who's going to go for this? So one question here is, how do you guys see the attitude of LPs evolving? LPs are the people who fund the VCs themselves. People often forget the VCs themselves have to pitch to raise their own money to actually fund the business in the first place. So how are you seeing the LP market changing in terms of attitudes there? The second question is about corporate venturing. It may relate itself to Matteo, but how corporate venturing is evolving in the current environment. Is that changing? Because obviously corporates might be the acquirers rather than IPOs, that kind of thing. And the third question is more about, it's more sort of fundamental, not fundamental, but sort of basic question about sectors that VCs fund. So the question is, if VC funding is available mostly to tech-based sectors, and we on our platform cover VC and P, and we have multiple. I spoke yesterday something in the chemicals industry. We have 133 private equity firms on Qodeo that invest in the chemicals industry. That's not technology in the true sense of private equity is a bit broader often in many senses. But they're saying with VC. Is VC available for businesses outside pure technology in an area like the arts? That's a very broad question, as we know obviously what the arts business does, but there are a few questions there, and if we can have those, I'll then wrap up quickly with a couple of comments, and then we'll go for drinks. So, want to go for any of those? Any of those take your fancy?
Right. So on the corporate venture side, I think they joined bandwagon of the last couple of years. So many new type of investors, including corporates, family offices, they said like, why don't we invest ourselves, sometimes directly. So, and the corporate were not the last one to join the party. I have to say, for direct experience, many corporates are setting up very serious vehicles. So, and the landscape changed over the last probably 5-7 years. So majority of the big names in UK, in Europe, they're now setting up either vehicles or investing in funds, or they set up corporate accelerators, investing directly. So looking back, we operate pretty much in most of the financial, industrial kind of legacy sectors. Many corporates set up, some vehicle to invest in startups. So I think it's a great choice. So they, specifically if you are in the B2B space, they bring in access to the customer base. So that's what you miss. Clearly, the flip side is you become appealing to them if you're bringing in something they don't have, which is typically is technology, a team, or access to a specific market they're not covering. So it's not for everyone. So I would recommend it as a go-to, as a first choice.
You work with
for
individual
fundraising.
sectors, so I know you work with Lloyd's on Lloyd's Lab.
Exactly.
So that's an insurtech kind of focus. Or IAG, you work with the airline sector. They're all kind of businesses around the airline space you can work with, but it's for businesses of that kind of sort, etc. So, and then the question of LPs. I mean, anybody got comments about the people who are funding? Because people forget that LPs, pension funds, principally with others as well, fund the VCs to then do the money, to then deploy the money in the first place, and the whole chain depends upon the LPs funding the VCs.
Do a couple of comments there. So we're out talking to LPs. We regularly talk to LPs. There's a couple of bits of negative feedback that could potentially reduce appetite for LPs. One is the denominator effect, which is effectively they've decided to stick 3% or 5% of their overall portfolio into alternatives or into VC. If the value of their public portfolio has gone down, which most have this year, then the relative value of their VC portfolio, which may not have yet been marked down, has gone down, or their pocket of cash to investors gone down. The other effect is a lot of funds deployed very quicker than historically normal last year. So funds that they would have invested in of a 2020 or 2021 vintage will have come back to their LPs saying, we're raising our next fund faster than was historically normal. So if they had the same size pool, they would be able to support fewer managers from that size pool. That being said, I think the attitude of most LPs, particularly the ones that have got past maybe their first or second fund investment, is that the performance in the VC market is probably here to stay, and they don't want to stop having it as part of the mix of assets that they're backing and how they deploy their money. So it's not going to evaporate overnight, but so it's always tough as an emerging manager and a new manager to get onto the roster for any LP. And as a founder, don't you worry. The VCs that back you will have talked to just as many LPs as you will have to talk to VCs to find a match. So it's the same dating game, just played out in a slightly different environment.
Okay. Sorry, just to add one comment, and from my perspective, the main sort of thing to look out for entrepreneurs is actually LPs that may potentially or could be sanctioned as a result of the war. That's probably been an effect that I've actually seen firsthand with one or two funds in the market, because even if the LPs aren't sanctioned today, they may be in the future, and then that sort of basically ruin your cap table for you and for future round, and maybe put off other investors.
Interesting final point there. Well, thank you very much all on the panel. I want to everybody thank them in the customary way. If I can get customary VCs, so if I can get Monica perhaps to bring out, we've got this bowl and there's going to be a prize draw. While she's doing that, I just want to mention that just remind everybody to go onto Qodeo.com, and if you get the voucher WOW Qodeo, we'll remind you of this, that gives you 50% off the annual concierge price. And we are doing a number of things in product enhancements that were mentioned by the speaker at the back in terms of improving the flow of communication between the entrepreneurs and the VCs. But at the end of the day, you realize that VCs don't always want or cannot always respond to all the volume out there. We're helping them sort of do some of that filtering process. Just want to mention also today there's some news, and my board members who are here, a couple of them are here, may not be aware of this. We have an advisory board that advises the steer of our business, rather than the main board or the US or UK boards we have. And today we actually got a new guy, an entrepreneur, joining our advisory board. Is Lord Billamoria, who's the founder of Cobra Beer, and also was president of the CBI until very recently, and very well with the Indian British business community, and he's just joined today to our advisory board. We'll hopefully do something with him in the near future. He had to wait till he rolled off the CBI role before he could take on other roles, and got approved today apparently by the House of Lords, has a process to approve which companies people can, so they do some sort of vetting to see if they're allowed to join an advisory board. We passed that, I'm pleased to say. So far anyway, you don't know in this current environment. We didn't ask Boris. So So if we can sort of thank everybody tonight, maybe sort of if Monica can choose, you rather me. You want me to choose? No, maybe ask somebody in the audience. What about Alexander on the end there? You can choose the card rather than just me doing everything. And if we read out who the person is, what you get is a year's free access to Qodeo as an entrepreneur and a box of chocks. So, oh, there we are. Thank you. There we go. Well, there is some food and drink now. Thank you very, very much for everybody for coming today. I think we've got about half an hour, 40 minutes available still in the building before they throw us out, but they'll probably be quite eager too soon. And there's lots of places around here, lots of watering holes afterwards you can head off to, but there is some food and drink, and please do take advantage of that. And for the folks who can stay, please network as much as you can. Thank you for all the questions and comments, and look forward to joining Qodeo and being in touch about future events, etc. Thank you.
Thanks, Simon. Good.